Any thoughts on Robinhood's S1? Obviously, I'm an interested party.
It's the largest fine ever, I think, of this type. But on the
FINRA's largest fine, yeah.
Yeah, so it should be a black eye for the company. But the reality is that they're happy to pay the fine and just move on. So they don't have this issue hanging over their heads anymore. And now they're going to be able to IPO at like a 50, 60, $70 billion valuation. And so for them, it's just sort of cost of doing business. I think there's something a little bit off about that, but that's kind of how it works.
Freeberg, anything?
I mean, congrats to you, J-Cal. Looks like you're going to do really well with this deal, huh?
It will return roughly, this one deal will do 3 or 4 times the value of the first fund, the launch fund one, which was $11 million.
So did you invest in the seed round or the A, or what round did you invest in?
I think it was the seed round.
And so what's your multiple going to be on a $50 billion market cap, do you know?
It would be 500x.
Amazing.
Congrats, big boy.
Yeah,
Congrats, J-Cal, and I'm happy to see that your success
I'm really happy for you.
Your success is finally catching up to your ego, and so I think.
Oh God, here we go.
I think
That's
too
it.
soon.
You blocked again. You're coming to get the shoe
Too
shine
soon.
box.
Too soon.
Your net worth is catching up to your waist size. Congrats.
Oh God. Well, actually, between this and the composition, listen, it's a long way to go before we distribute, obviously. But that first fund I did, which came after the Scouts fund, my Sequoia Scouts portfolio.
My only advice to you, Jason, is talk to a few seasoned GPs like Gurley, Fred Wilson, and figure out the right distribution strategy. One of the biggest things that I see these folks do is early stage venture investors thinking that they're public market investors, trying to time the market, trying to figure out how to do distributions, and it never works.
Which means, do you hold the shares for another year or two, or you distribute them immediately?
I would distribute them immediately, book the win, move on.
Yeah. It's interesting. A lot of the top firms that I'm in are holding their shares. And I had a firm that had Square, and they held some number of them until it's 7x and then distributed. So I guess technically they get to book that win. So what are your thoughts on that, Sachs, of when to distribute, and how are you doing it in your fund?
Yeah, I mean, it's a good question. The reality is that, let's say that you're in year 4 or 5 of a 10-year fund, you could hold the shares for another 5 years. And if the shares go up over that 5-year period, you'll do better. So I think the question
better
is
on IRR. Your numbers will look better.
Well, I mean, you're compensated on the absolute amount of return that you generate, and so it might. No, but
if you distribute the shares, and then if you're in carry and you just hold the shares, you'll realize the same gains. You're not.
Exactly.
Well, it depends what happens to the stock price. I guess what I would say.
No, but hold on a second. If the stock were to go 10x and you get 20% of those shares, if there were 100 shares, you had 20. If it 10x, you're still getting 20%, right, Camath? So it nets out to the same if you hold the shares yourself personally.
This is why I think that if you're in the business of running a multi-fund business, I think you're better off generally. And I think, again, if you talk to the best firms out there, they typically will not try to guess what's going to happen in the public markets. They distribute and they move on to their next fund. And then, because you have to remember, the IRRs, you go through these rough patches, it decays quickly. And all of a sudden, something that looks great can start to look not so great.
And the example of that might be Snowflake or something going down after it went public. And if you had distributed it, you would have booked the win at that high multiple.
Yeah. And then you're thinking to yourself, wow, I hope it goes back up. And then you're like, well, when do I distribute? These are all not things that venture capitalists should be engaged in. They should be there to help build the next David versus Goliath.
I think the counter argument to that is, if you really believe in the company and think you understand it better than the public markets do, or because you've been on the board and you have information, if you hold it for another, yes, there's going to be ups and downs, but let's say that you plan to hold it for another 4 or 5 years. You'll still get the same 20, 25% carry, but the point at which that carry will crystallize would be at like a much higher level. And so essentially you're preventing your LPs from selling is what you're doing. And so you may get an extra turn of your fund by doing that.
How do we feel as LPs, David Freeberg?
But there's also, isn't there like I'm just trying to pull up the Goldman Sachs report they did in 2019, where they analyzed 4,500 IPOs over a 25-year period. And I think that, and I could be wrong on this, but if I remember some summary of this, I'm trying to find it, so I can't find it right now. But that they basically highlighted that IPOs as an index generally outperform the market over some period of time, whether it's 1 year or 3 years. And so if you have access to those IPO shares, assume you're a venture investor you can beat the S&P by 10, 15 points just generally without having any thought about the business itself or the company itself. And, participate in 20% carry on the upside from there, or 25% carry on the upside from there. And so generally the rule of thumb becomes, well, you shouldn't distribute right away, you should hold. Is that not kind of a common dogma amongst GPs nowadays?
Well, look at Square. Look at Square. I mean, Square had most of the appreciation happened in the public markets. I think Sequoia held onto their Square shares, did way, way, way better because nobody sold effectively for several years. And the
best firms do this, right? I mean, we hear from Gurley and others that, they hold on to these shares for years. And, a good business going public has a much better chance of performing well as a public company than, just tracking the S&P after an IPO, regardless of the valuation it exits at.
Well, how do we feel as LPs, Chamath? Your LPs in a lot of funds. I'm in 15 funds. You want your shares.
I don't know, no offense to any GP out there, but I don't think they're as good of a public market investor as I am. So give me the shares. I'll manage it myself and get out of the way. I give money to to your point, a lot of GPs because I want private market exposure. I don't want them speculating in the public markets for me. I do that for myself. And so I would rather just get the shares and make my own decision. A lot of foundations, for example, are in the situation where they're there to fund programs. So if they have a, multi-$100 million position in a great company, and they can't fund a program or a hospital system can't do what they need to do because some GP is speculating in the public markets, I think it's insane.
Mm-hmm.
So give the LPs the money and move on. It's not your job. Otherwise, you should run a generalized fund. And most people don't because they can't.
Generally, how do you guys, when you are a large owner in a company that goes public, or just say the pool of venture investors or owners in a company that goes public, and the lockup is expiring, typically 6 months after the IPO, and you can now distribute your shares to your LPs, do those, investors take note of or have concern about the impact it might have on the stock price when they're making those distribution decisions typically?
I think they think about that, but a lot of these LPs, particularly the nonprofits, they're forced day one sellers the minute that they get the stock. They
That's
just
my
put
point.
it
It's
out.
like as soon as the stock gets distributed, everyone's selling and the stock takes a hit, right? And I think the market
there's something happening. This is speculation that I don't have. So just, take it as that. But my understanding was some investment banks went to and Chamath might know the background on this, went to some of the major LPs in the world, I'll leave it at that, and said, hey, you have a position in, this cab company. It's going public. It's fully valued or it's very well valued. Would you like to collar your shares before that? And we will take them off your hands and lock you into a certain price for some percentage of it. Basically, end running the GP's decision-making process. Of course,
there's a lot of that happens. This is why I'm saying I think the GP is better off. If you're in the venture fund business, be in the venture fund business. Do a great job at that. Raise funds, distribute cash, do what you're supposed to do. But please don't try to do something. It's kind of like asking, the firemen to also operate on you. No, I don't want that. Take me to the hospital and let the doctor do their job.
I think it's a very valid perspective. I think it's probably the baseline that VCs should operate from, but I do think there are exceptions where if the VC's been on a company board for a while and feels like they understand the company better than the public markets, especially during the first 2 years as a public company when the markets can be really choppy and the company's trying to find its level and people don't really understand it. I think there is an argument for the VC having expertise in that initial public run, then they might be doing their LPs a favor by holding. But look, I think Chamath's point is well taken.
Also, companies are going public earlier. So this is going to become a bigger issue because it's an easy decision in year 11 if you were an Uber investor or an Airbnb investor to say, okay, it's been 11 years. We're going to give you your shares. But if you're in year 5 and the company goes out so early, you could make an argument, hey, maybe we hold it for 2 or 3 years.
Just going back on the previous topic, JCal, the FINRA news on Robinhood, right? So FINRA, just so everyone understands, is not a government regulator.
It's a private entity.
It's called a self-regulatory organization. And these SROs are basically, they have a board and a bunch of people that run them. but they're pooled and managed by all the participants, the private participants in the market. So Goldman Sachs and Morgan Stanley, and JP Morgan, and all the banks, they are all part of the FINRA SRO. And so the way that these SROs are set up is to avoid government regulation and to avoid government intervention in markets, and allows the markets to effectively self-regulate themselves in a way that everyone in the market is kind of keeping an eye on each other and making sure that this is being taken care of. And I think one thing to take note of from this fine is that it telegraphs that FINRA and the markets in general, the market participants in general, may be rather concerned and rather worried about government intervention in some of these new markets and emerging fintech practices, because they wanted to say, look, we put the gauntlet down on Robinhood. We made them pay the biggest fine ever. We made them pay $70 million. Stay away. We're taking care of it. Because the concern everyone's had is that AOC and Elizabeth Warren and a bunch of people on Capitol Hill are waving flags saying, we need to step in. We need to regulate these companies. We need to regulate these practices. We need to protect consumers. And so this fine really signals that the market is a bit concerned that the government is going to come in and start trying to tell fintech companies how to practice and how to operate, and generally tell all market market participants how to operate, which is a very scary prospect for them. So to me, this was really big news about what it telegraphs the backdoor conversations are, that are going on with market participants right now.
What you're almost saying is that this is a benefit to Robinhood to pay the largest fine, because it says to the politicians, look, we've already been punished in this, maximal way. You don't need to layer it on top. So in a way, it's better for Robinhood that they paid 70 million instead of 10 million.
Yeah, and it's not, by the way, it's not even for Robinhood. I think all the market participants, JP Morgan, Goldman Sachs, they all have huge, tech teams, and they all have acquired fintech companies, and they are all trying to go digital. And everyone is worried about the government intervening and changing how this business is transforming, because as soon as the government gets involved, it's going to slow down the transformation. It's going to, make things much more challenging. And I think that everyone's trying to keep the government at bay while the great digital transformation of markets is underway. And I think that's like the biggest signal from this FINRA fine.